Welcome to the video tutorial Financial Management. This short tutorial has been prepared to provide you with a brief overview of the concepts of financial management. The following topics are addressed: areas of financial management, accounting perspective on finance, institutional perspective on finance, investment, risk management, financial risks. The video tutorial will be concluded by an imprint. Which areas belong to financial management? The real economic area comprises the operational subfunctions of procurement and human resources, as well as production and sales. The financial management area, for which the generic terms corporate finance, business finance, and managerial finance are also used, must be distinguished from this. Financial management comprises the three areas finance, investment, and financial risk management, each of which addresses different subject matters. Financing includes the procurement, recovery, restructuring, and outflow of capital. Investment entails the conversion of financial resources in non-liquid assets. The task of financial risk management is to manage financial risks. Occasionally, financial risk management is integrated into the areas finance and investment. Financial risk management is presented here in an isolated form to illustrate that it is also a separate part of financial management. Finance, investment, and risk management together enable the financial cycle, which is intertwined with the real economic area. The financial cycle will be examined in more detail in the following unit. How can finance be described from an accounting perspective? It has already been explained that the area of finance can include the procurement, recovery, restructuring, and outflow of cash and cash equivalents. In this context, cash and cash equivalents are means of legal payment. In addition, near money assets can also be considered. These include, for example, receivables or payables that may also be relevant to financing. This monetary or quasi-monetary perspective addresses various aspects of the term capital. This will be illustrated by 4 groups of finance transactions with exemplary cases and the description of the corresponding balance sheet effects. The first group of finance transactions concerns the procurement of capital. Example: a company takes out a bank loan. The balance sheet effect is a balance sheet extension. The second group of finance transactions concerns the recovery of capital. Example: a company sells its finished products on a cash basis. The balance sheet effect is an asset swap. The third group of finance transactions concerns capital restructuring. Example: a company replaces a bank loan with equity. The balance sheet effect is a swap of equity and/or liability positions. The fourth group of finance transactions concerns the outflow of capital. Example: a company repays a previously borrowed bank loan. The balance sheet effect is a balance sheet contraction. How can finance be described from an institutional perspective? Finance, from an institutional perspective, can be defined as all measures that are taken in order to source and repay funds, as well as the arrangement of the corresponding relationship between capital seeker and capital provider. The focus on sourcing and repaying funds corresponds to the intuitive interpretation of the term finance. In addition, the definition explicitly refers to the structure of the relationship between capital providers and capital seekers. This can be illustrated by means of 5 areas of arrangements and an abstract description of the matters affected by them. A. The first area of arrangements concerns the aspect of payments. It concerns the definition of the modalities of payments between contractual partners. B. The second area of arrangements addresses the aspect of information. This concerns the definition of how and when a regular or exceptional exchange of information between the contracting parties takes place. C. The third area of arrangements addresses the aspect of control. It concerns the regulations on the nature and scope of institutionalized control mechanisms and the control bodies that have been established. D. The fourth area of arrangements addresses the aspect of security. This concerns the definition of the type and scope of collateralization of payment claims of the capital providers. E. The fifth area of arrangements addresses the aspect of sanctions. This concerns the modalities of enforcement in case of an event of default. What forms of investment can be distinguished from a time perspective? Investment is defined as conversion of financial resources in non-liquid assets. Long-term use of capital involves an investment in assets that are used in the company over several periods. An example: a company buys a new production line with 100 industrial robots for one of its plants. Another example would be: a company procures raw materials and supplies to build up a permanent reserve in the warehouse. Such a permanent reserve represents a sustainable and necessary prerequisite for the provision of services. The permanent reserve thus takes on a de facto long-term character, because the corresponding funds are tied up in the company over a longer period of time. Short-term capital expenditure involves an investment in assets that are used or consumed during the year. An example: a company procures raw materials and supplies for use in current production. Occasionally, the concept of investment is narrowed down in the literature. An investment in the narrower sense of the term is only the long-term commitment of financial resources in non-liquid assets. What are the main fields of activity in financial risk management? Financial risk management involves the analysis, management, and control of financial risks. Risk analysis refers to the identification, classification, measurement, and evaluation. Active risk management serves to avoid, limit, reduce, transfer, and/or diversify risks. Passive risk management is used for cost accounting compensation and balance sheet provisions. Risk control means checking the analytical methods used, the suitability of instruments, and the organizational implementation in the company. What are the components of risk analysis? Risk analysis refers to the identification, classification, measurement, evaluation, and assessment of financial risks. Identification means that sources of risk in concrete individual transactions, business segments, or operational functional areas are revealed. For example, a German company that invoices a portion of its business in US dollars might realize that its business is severely affected by exchange rate fluctuations. Classification requires the classification and naming of the identified risks. For example, the company could conclude that it is subject to market risk in the form of exchange rate risk. Measurement means that the loss potential is determined by using suitable quantitative instruments. For example, the company could determine the standard deviation observed in the past. Evaluation implies that the calculated loss potential is further processed into risk-adjusted profit and return figures. For example, the company could determine a potential maximum loss on the basis of the standard deviation observed in the past. What are the components of active risk management? Active risk management serves to avoid, limit, reduce, transfer, and/or diversify risks. Avoidance means that risky transactions are not executed. For example, a German company might decide not to enter into transactions in foreign currencies in order to exclude an exchange rate risk. Limitation means that upper limits are set in the form of maximum amounts or limits. For example, a German company could decide to conclude transactions in US dollars only up to the equivalent of €50,000 per individual transaction. Reduction implies the cause-oriented reduction of risk by structuring transactions and deals. For example, a company could decide to offer its customers only contracts with price escalation clauses that are flexible and adapt to the respective exchange rate. Transfer means that parts of the risks are transferred to third parties through hedging measures. For example, a German company that expects to receive revenues in US dollars could use currency option contracts to hedge against exchange rate fluctuations. Diversification aims at a qualitative spread of risks across regions, industries, business partners, and/or a quantitative spread by means of portfolio models. An example, a company could decide to conclude its currency option transactions with multiple banks to hedge against the default risk of just one bank. What are the components of passive risk management? Passive risk management is used for cost accounting compensation and balance sheet provisions. Cost accounting compensation means that risk premiums are taken into account in the calculation of product prices and charged to customers in order to indirectly compensate the risk through higher earnings. Example: the German company charges US customers higher prices to compensate for exchange rate risk. Provisioning. Provisioning on the balance sheet means that a corresponding reduction in profit distributions is initiated or a risk buffer is created by setting up value adjustments or provisions. Example: the German company adjusts the value of receivables denominated in US dollars by way of partial write-downs. What are the components of risk control? Risk control means checking the analytical methods used, the suitability of instruments, and the organizational implementation in the company. The quantitative analysis methods used can be checked for certainty of judgment and further developed if necessary. Example: the German company validates its statistical model for deriving standard deviations. The appropriateness of risk management instruments should be monitored. Example: the German company analyzes whether the contracted currency option agreements are still the best solution. The organizational implementation of risk management must be periodically reviewed to ensure that it is working effectively. Example: the German company reviews the internal decision-making powers for the calculation of risk-adjusted product prices. What are the most important financial risks? Financial risks in the narrower sense include market risks, credit risk, and liquidity risk. The term market risk includes the risk of price or value changes. Depending on the type of the underlying financial contract, it can take on different forms. Interest rate risk addresses the risk of interest rate changes. For example, loans with variable interest rates involve the risk of rising interest payments. The exchange rate risk addresses the danger of exchange rate fluctuations. The price risk and the commodity price risk address the risk of possible decline in the value of securities or commodities. Examples are falling share prices or rising oil prices. The credit risk addresses the problem of losses when granting loans in cash or in kind or when granting a term of payment. Default risk addresses the danger of a temporary or permanent inability of the borrower to make payments due on time and/or in the correct amount. This is the case, for example, if a customer who has been granted a payment period does not settle his invoice within the granted payment period. The collateral risk addresses the risk of a possible loss of value or the impossibility of legally enforcing loan collateral in the event of realization. For example, a bank could register a mortgage on a property that may be affected by a general decline in real estate prices at the time of realization. The concentration risk describes the danger of insufficient diversification in the business portfolio. An example would be an automotive supplier that exclusively supplies a car manufacturer with one component and regularly has to grant long payment terms. An insolvency of the car manufacturer would endanger the existence of the supplier. The liquidity risk comprises the risk of limited access to cash or cash equivalents or access that is unattractive in terms of cost. The refinancing risk results from the financing of tight assets on the asset side through borrowed funds available for shorter periods on the liabilities side. As a result, maturing borrowed funds have to be replaced by new borrowed funds or equity because the capital is still tied up in assets. For the company, there is a high risk that follow-up financing cannot be presented. Refinancing is therefore not possible. The maturity mismatch risk or term risk addresses a situation in which incoming and outgoing payments are not sufficiently synchronized. In a given period, the sum of payments received is at least equal to the sum of payments made. However, there are liquidity gaps if disbursements have to be made before the incoming payments are received. The commitment risk describes the risk that a credit line granted by a company is drawn down by the customer prematurely and/or in a larger amount than expected. The management of the commitment risk is of existential importance, especially for banks. However, the commitment risk can also lead to a liquidity crisis for trading and industrial companies if customers, contrary to expectations, exhaust the payment terms granted to them. There may be a close connection between financial risks and other risks. Operational risks address the risk of disruptions in business operations. These include, for example, a failure of data processing and telecommunication systems or unexpected staff fluctuations. The force majeure risk addresses the risk of so-called acts of God. Examples of this are war, riots, and strikes, as well as the occurrence of natural or environmental disasters and pandemics. Country risk is a collective term for politically and/or economically induced risks that may occur in transactions with or in certain countries. These include, for example, forced expropriation by foreign authorities, unexpected changes in the law, or the drastic decline in local purchasing power. Supply and sales risks comprise risks resulting from the goods and services process. These include, for example, the shortage of certain raw materials necessary for operations or a decline in demand. It should be noted that there are other risks and that the risk mentioned here can be further differentiated. Risk management considerations also apply to other operational subdivisions. This can be explained by using 3 examples. The management of IT risks is the task of business information management. The management of logistical risks in the supply chain is located directly in the operational subfunctions of procurement and production. The management of sales risks is the task of the operational subfunctions sales and marketing. It is not always possible to distinguish clearly between the risks of other areas and financial risks. This can be illustrated by the supply and sales risk on the one hand and the commodity price risk on the other. It is clear that the analysis, management, and control of risks can overlap. For this reason, financial risk managers are often commissioned to manage other risks due to their special competence and capabilities.